Hello, hi, ladies and gentlemen. We've got 1500 in Geneva, in Switzerland. We can hardly call our today's event multinational because I'm in Geneva. My co-speaker, Peter Zmidzinski, is in Zurich, so we have kind of Swiss event. But I do know that people are joining us from all over the globe. So thank you very much for finding time for us. And please, I forget to say that. Please type your questions in chat. And corporate policy of credit engineering, although we could not call our company as a corporate, but one corporate policy we've got is that we never leave unanswered questions. So please type your questions, ask them. If we have time, we will answer them today in the Q&A session. Otherwise, I will answer them in public. Today, I got a quite interesting and professional co-speaker, Peter Zmidzinski, who is a treasurer and who is a credit analyst and who is the treasurer and the credit manager. And I used to work side by side, back to back with treasury for my whole corporate career. Therefore, for me, treasurer would never be an empty sound. Peter, welcome to Credit Chats.
Andy, thank you very much for the invitation. Always a pleasure speaking with you. So thank you.
Thank you. My first question will be about you. People already, those who wanted to know about you already read our post in the event. But I ask everybody a tricky question. So, who do you feel you are? I know you are treasurer. I know you quite close to credit management where we are colleagues, but just question about you. When you need to represent yourself in one word or maybe one sentence or maybe a couple of sentences, the shortest version of representation who you are, what would be? For me, I always give an example. The creditologist means CICM, CICP, CGCE, and all of these designatory letters, which one day became longer than Andrisichka. Therefore, I decided that it should be something shorter. But for me, credit management is a profession, piece of bread, hobby, object of research, and so on and so forth. So,
who is Peter?
I am quite narrow in this world, but I believe you are a bit wider. So, who do you feel you are? Whom you feel yourself?
That's an interesting question. I always get asked. I always sometimes contemplate that just about my background as well. So, for the people who don't know, I've got I was born in Poland, got a Polish background, but I grew up in Australia, and that's where this lovely accent comes from. So, my answer to that I combine the personal and the professions together in a way. So I'm an international man of finance and innovation who who's passionate about what he does every day and loves the summer. That's why I put the beach in the background.
Yeah. So this is Australia.
I think so, yes. I'll say yes.
I mean, we will keep it as a secret, but I told you already that our event Credit Chats has Australian roots.
Exactly.
So let's get back to our topic. So today we had a bit of fun on LinkedIn about two gentlemen discussing models. What should we understand under the model? This could be really anything, like little car, little plane, beautiful lady, or something else. But today, obviously, we will be speaking about the credit risk models, and we will be speaking about. It might sound funny, but personally, I prefer to use every tool in my profession with clear understanding of its properties. So when we got a result of model, what we've got, what are the merits and limitations. So let's us dive in from the very beginning, from a simple question: what is the model, and what is? We speak about credit risk models. What is the model, and what it really models?
No, thanks for being specific on that. Otherwise, we'll go into other topics as per your poll.
I believe so.
On the face of it, if you look at the question, it seems quite simple, and we can answer these in 10 minutes and go for a beer afterwards, as we would in Australia.
Let's
dig deep. Let's dig deeper. Let's scratch the surface. I mean, credit models, the way that I look at it and my experiences was it's a framework. It's a framework. It's a calculation method. It's a methodology whereby people would want to quantify a certain event based on different data sources, and you do that for specific reasons, and you do that for specific reasons to determine a particular decision process or decision making process to come up with a result. Now that's the kind of dictionary, Wikipedia kind of explanation, really brief. I want to take a step back and maybe talk about the story of a credit model. Why? How do we get there, and why does it existentially exist?
We can
for our
even
purposes,
start
right?
from where we can start it. So let's. I mean, one of the most nice scientific advices I heard myself is that let's speak about the history of the question. So since when we know credit models? Why not?
We could go down that way.
Yeah, I mean, this is the suggestion, because you said let's speak about the background. Let's do step back, because our idea today is to look at all these models from a bit critical way, from a bit critical angle, and understand. But because even I will explain. Let me put cards on the table. More and more I hear from the community, from credit community, that credit analysis is just like taking customer financials, calculate whatever score is, and then this is supposed to give us a clear decision to grant or not to grant credit. I would say, if this would be that simple, why did we have 2008? If it is that simple, just calculate and have. Although, I mean, I believe everybody here understands that if there is no recipe like take 1 + 2 + 3 and then you got 6 as result. If business would be that simple, we will all fly spaceships. So let's come back to the background and how do we practically use the models, and what do we model, and let's see.
So the way that I kind of wanted to address it is more from the perspective of and especially when I start my own business, you kind of and yourself as well, you kind of think from the process of most people think about credit models being a bottom-up approach. You have a quant, you have a mathematician, financial wizard, wanting to make some sort of calculations and push out this philosophy amongst a company. But I see it in a different way. I see it from the perspective where it's more of a top-down approach. And the top-down approach is where you have the board or top management, being CEO, CFO, they're juggling revenue generation, margin increases, and also cash collection, because they need to get that in a cash form. But to derive the business, to grow their business, part of they need to make a certain risk-adjusted decision. Now, what is that risk decision? It's a saying, I'm happy to have at risk a certain amount of money in order to win that business. And that's that risk tolerance. And then that risk tolerance then gets filtered down into policy, credit policy in a way. And from that credit policy, a credit risk model gets derived. And we can talk about the derivation, how the methodology is, data inputs, interpretation, methodology, and so forth later.
Mm-hmm.
But that's the way that I kind of see the flow of how credit risk policy, credit risk models get generated in order for its usage, and then we come up with a kind of like a collaborative method, sales and the quants, the financial guys coming together to derive and allocate this tolerance level, this credit risk, this credit limit level against the portfolio of customers. And so that's how we should become, because what does that mean? And this is where I'm going to come to the beach in the background in a second. There's an analogy behind there. What does that mean? It means that you are assigning responsibility, assigning accountability to certain levels of your company. Because if you want to go over that threshold, then that's another discussion level. But for the initial, you're drawing a line in the sand, the line in the sand in the beach. To say this is where we're going to go up to. Anything over, let's have another discussion. And I think that's how this sort of story of credit policy, of deriving a credit model comes really from the top and filters through. It's sort of the business strategy filtering through into the daily organization. What do you think about that?
I would say that I'm happy to know that you share the idea that credit management is impossible without portfolio analysis. Too many people in the world believe when you say portfolio analysis, they say, "What? Sorry." Yeah. So portfolio analysis is one thing, and I clearly understand that. Modeling credit risk is actually one of the ways to combine all of risks we got in portfolio. Either way it is possible to do. Value at risk. Our portfolio approach where we show credit worthiness in money and show risk as difference between demand and whatever. But simplifying that, I would give an example. I was working for the company. I had very smart CFO. I used to work for the CFO, and he said, "Andrei, this credit decision you came to me, does it increase the credit risk we take or decrease?" I said, "Obviously, it increases." And then he said, "Okay, let me ask you another question. How much risk do we take? How much credit risk now do we take?" And then I started to find an answer. This is the stage where I completely agree with you. So models the possible default or possible consequences of a default of a certain counterpart. So this allows us to combine them into portfolio and see. I will repeat it once again. So today, ladies and gentlemen, we heard that from the Peter. In 25th century, taking credit risk for majority of businesses, especially outside of financial sector, is not a question of choice. It's a question of how much credit risk you have to take in order to achieve your goals. And then it's a question how much credit risk you are able to, you can afford. And if you know neither, you simply, in terms of getting cash, you simply go to casino and play. If you are lucky, if you are happy to rely on luck, no worries. But I believe you are not tranquilizing yourself with understanding, because about models we will speak. I will give a couple of funny things. But on the other side, there is. I will make a bridge to maybe a couple of our next questions. I clearly understand portfolio approach and clearly understand this border and everything. But at the same time, when we take a credit decision, we are working with individual customer, and it's very good when we have a luxury of let's say consumer credit, where we got statistics for several years, we know defaults, we can model this, and we got it. And we know that impact of one individual customer is not that high. But if we are in B2B business, like in trading, and we got big customers, and we need to structure business with them somehow. And we understand that impact of one customer is, say, 10% of the portfolio. Let's not speak about big concentrations, but this could also be the case. But in that case, whether or not simply model could be a result of a model, could be a decision. So this is what you call bottom-up approach. Yeah, because I had in the very beginning of my career, I had a discussion in the room, sitting in between sales director and CFO. Big customer, big deal. And I was asked, can we grant a credit to this company? I said no. Why? Because their default probability is 10%. And I mean, everyone who is in banking, who has idea of portfolio analysis, especially in banking, would say that 10% default probability is quite big, if not enormous. But reply of the sales director was quite simple. 90% probability that customer gonna pay is enough to me. I still don't have argument to him to say something.
Yes.
Yeah. So because we got business, we got people who are ready to purchase
Ambitious,
our
yes.
product, and who are ready to pay for it. And this is proven historically they pay, but 10% default probability. Here we are coming quite deeper to the heart of the issue, because there are a couple of issues. And the thing is, when we say default probability, which is most common for the model, we understand that the model says us that customer will default or go bust with certain probability. But to me, there are a couple of reservations to it, but and I would like to discuss with you the first. When we say when we say the background of the model, we always, and everything I've read, including Altman. So I know Altman not from the Wikipedia page.
Original text.
Yeah, I was taking original text and I learned a lot. So each time I have to give an advice about the credit risk. So where to learn credit risk? I said, open Altman's book and read. As clear, as detailed, as careful as possible. But the thing is, with all the models we got, which predict corporate default, they all built on historical data. And as such, because I always speak about these stochastic models, and does that mean that outlier is not included into the model? So what if, we can call it black swan, but whether or not, my personal problem with the model, I will explain, try to explain once again, is only one. If we need to predict 10 defaults or 100 defaults, I would rely on statistics myself. That's clear. But when we say about the big company, like Enron, for instance, or like any other, does that mean model, or does that mean really credit analysis of a credit analyst? Because model is normally based on history, quite similar, by the way, to payment behavior, and past not necessarily predicts future. That's the thing.
Exactly. Yeah, I think exactly. I mean, a model is only as good until it's not, right? So there is a certain event where, and I'll give you, and so precisely, you mentioned the GFC before. I at the time I worked at Lehman Brothers. I was sitting on the trading desk. Next to me was a whole bunch of quants, physicists, and so forth. And they could probably build a spaceship to land on the moon. However, they could not predict the GFC. They could not predict certain defaults of instruments and so forth. So a model, even with all these brain power, all of these things, you cannot predict it. So how far do you go back? And I think it's a combination of calibration of your modeling, a constant calibration, re-feedback and so forth, but also the data that you're using, the actual source of data. It almost does not matter what model you are using, but getting the frequency of the data, establishing a trend of that data, because that's when you start seeing the results, the trend of the results. For example, if they're getting worse, then that is when you should be taking more action and so forth. But that is what is required. And that's what we look at constantly in terms of getting not only financial statement data, which is fine once a year, but maybe getting on a more frequent basis. If it's a particular industry, like during the pandemic, some of our customers were getting data on a more frequent basis from their customers. There's more. You should be utilizing unstructured data, such as it could be business intelligence, sentiment analysis. So there's different inputs that could be creating a better output or adding more value. As you said from the beginning, you want as much information as possible. So it's a constant recalibration, rejigging of the model. It's not a standard. It's not a standalone.
Absolutely.
Let's measure once and forget about it, right? So the historical part is important. You use it in context to build a picture, but at a certain point you need to, like I said, recalibrate it. And using black swan events probably creates upper lower barriers that you can work within, but it's kind of, you still need to work within those parameters. So there's I really think it's, as you said, the data, but how far do you go back in history? And not everybody's got the history. If you have a brand new customer coming on board,
absolutely, what
do? You use a proxy against similar companies, or you take a risk? But again, it comes back to the line in the sand. When you can, if there's a conscious decision amongst the collective management to take that additional risk, because it's additional margin, strategic decision, whatever the case may be, then I think it's a fantastic. I think as long as it's clear, if there's a default or a late payment or whatever the case is, there is accountability there, right? And nobody can say, I had no idea.
Well, that's I know normally I explain this in a bit different way. First is that when we speak about, let's say, smaller part of the portfolio, or let's say a smaller economic agent like a person or a household, which are thousands of them, so we can predict the population here there, but when we speak about big corporations, quite big number of people, quite big, and there are many things which could happen, from business decision of CFO to execution excess of the right person. We already seen in Suez Channel, just one mistake of a captain, and the whole global economy has a trouble. I mean, who did predict that? No one. And also, one more thing. I've heard quite funny things in conclusion. Like I always say, when we say about payment discipline, I always give a quote, bring a quote, which I've read in the credit request in a big corporation. There is no credit risk because customer paid last 2 invoices on time. And coming back, and since we are moving closer to the question of accuracy, so we receive default probability mainly based on similar companies or mainly based on the population of companies in a specific market, which means model. But this everything is past retranslated into the future. So with certain probability, we might have this or that company defaulted, either extremely late payment or bankruptcy or liquidation or whatever it is. But we both seen, or we all seen, ladies and gentlemen, that COVID made a significant change to that. So the company which used to be credit worthy as of December 31st, 2020 might not be that in, let's say, in a couple of months. Because, you know, all this funny, with everything, with all the history, so company might be extremely credit worthy, but then something changed. And again, this is the question to us. Either, or if I understood correctly your approach, this means that we should never rely on past if we got significant change in current days. So this means that we need to adapt our model, or we need to do a stress test.
I would say the historical forms the basis for a trend. The trend is always your friend in trading technology, in yes. trading terms. But we should be utilizing as much as possible the latest information.
Sure.
Nobody would have given, especially with the volatility in the markets, with the pandemic and everything else in the market that's happening at the moment, things are a lot more liquid than they were Absolutely. 10 or 20 years ago. And the models have not caught up to that. So we need to adapt or utilize additional information in order to combine and make a more better judgment in place. And credit policy needs to be updated to reflect that as well. I don't think that is the case. I think they're still relying on an old school, Altman Z-score or some other sort of scoring method, or Dun & Bradstreet report, whatever, right?
Because we are speaking about accuracy. We will
exactly.
mention then all the policies, all the models and the score as well. So there is nothing wrong about that score. But since you mentioned that, I was reading, as I said, Altman quite carefully. And since I read that, I always ask authors of models and the people who use that. When people say our model predicts default with 90% accuracy, I say that's perfect. But what is type 2 error? And then they become extremely sad. Because to me, the biggest problem with these default probability models and their wide use, actually two. First one, and I think this is the biggest stereotype of modern market, is that a result of a model or customer credit worthiness is confused with the credit decision. I believe you know as much as I am that too many people, lots of advertisement on the market say credit risk assessment is a decision. Credit to good guys and the cash in advance for bad guys. But reality is different. With all due respect, ladies and gentlemen, reality is different. I mean, 75% or so companies in the world cannot afford choosing customers. You find customer and you need to find a way to work with them. And sometimes this would mean accepting credit risk. Mm-hmm. But everybody say you assess, credit assessment is a credit decision. And then you speak to other parts of the business and people say, Andrei, if you assess this customer, you will never grant him a credit, but we have to. So here is the contrast. And this leads me to my next sentence. So type 2 euro says that how many customers have been marked as potential defaulters, but they survived. And even Altman, he created his model just before I was born. In 1968 or 65, if I'm not mistaken. So he says that recovery rates are extremely difficult to predict. So which means that with type 2 euro remaining on the level of 25%, which is quite high, we say that about out of we say that 25% of the modeled population we used for the model called bankrupts or potential bankrupts, but actually never went bust. And if we use this model this way, as I said, like risk assessment is already a decision. This would mean that we are cutting our legs or cutting ourselves and cutting the bunch, the branch we're sitting on. So to me, this is the biggest problem with the model, is that we never take it. We believe that when the model gives us a default probability, which would mean, we got default probability, or which is quite high. The model calls, if we use that score, let's say below 123, which means that the company is supposed to go bankrupt. But what if it not?
Yeah, I can give you an example there, Andy. I mean, in the past, I was group treasurer at Swissport. It's an aviation support company. Headquartered in Switzerland, but in 48 different countries around the world. There I set up the credit department. We had nothing. The company was focused on revenue. Suddenly we needed to develop working capital or improve working capital, and credit risk was part of that as well, because they go hand in hand. Improvements in working capital helps out actually their credit risk exposure. You would never give credit to any. If you look at the balance sheet of most airlines around the world, you would never give any credit.
I got experience with that. I've seen them. I've seen them.
So what we've done is a little bit of a different approach, and this is why I to all your listeners as well, for them to have a look at internally and apply a credit model that applies to their specific industry. We applied various ratios, and I think it was Altman Z-score as well, but overlaid it with payment behavior and so forth, and sort of other measures that we knew that we were going to, that kind of adjusted the score to a level that we could be more comfortable doing business with them. So we gave credit to airlines, and mind you, we didn't give 5 or 10 year loans, right? It was only 30, 60 days. So we're not talking about something that's like a mortgage type of product.
Yeah.
By trade credit of that nature, we were comfortable to, based on prior historical payment behavior. This is where we work with sales in order to feel, or the management feel comfortable in order to do that. But at one point, if payment behavior became worse, then the limit got cut, and that's where things of that nature we were applying as well. So you're perfectly right. I mean, you need to adjust the model to make it work for your industry, because you need to provide some form of credit, but you need to be comfortable with that credit as well and make a risk-adjusted decision. Yeah.
This is, here I was working with this issue.
Yeah.
Because I faced this issue in practice quite early in my career. So it was like maybe more than 12 years ago. But what was interesting, I did that mistake personally, like applying that score as it is, because it's elegant. The model is simple. You just calculate, and you see here is the credit risk, and so on and so forth. But the approach I found for myself was just a little bit different. My understanding is that risk assessment is to be as objective as possible. Obviously, we may decide to include or not to include payment behavior, to me, they are not linked with companies' financial strength. There are strong companies who pay late. There are small companies who pay on time, but they pay on time to don't pay on time to others, and so on and so forth. So we can obviously digitize all of this, but main idea to me is that we need to assess creditworthiness as objective as possible, as precise as possible, and then take risk as it is. Therefore, I believe the biggest and most beautiful event we had in 2015 was adoption of new IFRS and IFRS 9, where we can finally turn risk assessment and actually risk from looking back to looking forward.
Mm-hmm.
And we understand that if we give credit to risky customer, we can create bad debts provision right away based on customer default probability. And that's one of the ways. Another way, which I found quite interesting, when you reflect creditworthiness not as default probability, but as money. Because most simple and most clear way for people to understand and when they take decision is not probability. I gave you already an example of a sales director.
Exactly.
And as we're still speaking about accuracy and as we're still speaking about clear understanding, we may calculate default probability of a company, but small company which with financial, let's say with 1,000 or maybe I don't know 100,000 turnover, and a company with 100 million turnover may have the same default probability. Does that mean we will give them equal amount of credit? I don't believe so. So to me, when I was formalizing a question to myself as a credit analyst and to my teams, my simple idea was to say, I need to give one simple idea to credit analyst what his job is about. And to me, credit analyst is supposed to give one simple answer: how much money we can trust to this company safely. This could be zero, this could be 1,000 millions or billions or trillions, whatever, but give me clear number.
Exactly.
As soon as people know this number, the magic starts, because they compare money and money. So we need to give these guys, based on business, what we call credit demand, to sell, let's say, to start selling to these guys. We need to give them $1 million credit. What's their credit worthiness? If it is like 10% default probability, this one story. Another thing, if the answer is $500 million, that's become clear. Even to marketing, HR, I don't know, cleaning, even to kitchen lady understand that we need to give 1 million, and the credit worthiness is $500,000. So we need to put on the risk $500,000. This is the idea. And again, if we turn back to that, it's never only historical data, because we need to look forward with that and what happened to company. And this what gives us an opportunity to see it, to look forward. My understanding is that we need to, when we speak about customer risk, we should never, past is okay, but how many events in the future are actually grounded by our past? We all have surprises.
Yeah, we always have our skeletons in the closet, right? So that's
absolutely.
That's always the case.
Absolutely. If I look at my life statistically, couple of times I did that exercise. I understood that statistically I supposed to already be dead. technically speaking.
I'm glad you're here. But just going to that, I mean, how many analysts actually have the time, or how many credit managers in corporations have the time to dig in and actually look into a proper financial statements and try to find those skeletons in the closet, whether it's through accounting modifications or whether it's through whatever the case is the expertise there, is the thing. So I think we tend to rely on more simplified modeling because it's easy for us to understand and apply it. And so we don't really dig in unless it's a brand new customer, and then that's the case. But something that's been around for a long time. So still, I think our default is going back to historical context. My gut feels, or my experience is that nothing's going to happen here. Plus, my model suggests that as well, and that's how we move forward. I think that's how most corporations operate.
I believe there is no future where computers replace people, and I don't believe there is future without computers. Why? The future I believe in, really believe, because no one knows the future. One thing I know for sure: no one knows the future precisely. So the future I believe in is the perfect is a better and better and better keyboards. So combination of smarter people with better computers who do better job, more efficient job. So if we look at if you ask me to draw a picture of how this new future would look like, I would say models. Just a sec. Models give us, and computers are much more better than people in assessing the current situation. So model gives us an opportunity to take data of all the customers and in seconds calculate all the ratios and see what happened. And if there is a change, we look deeper into details and investigate, because we need to take decision on to understand what to do further. But human being could not be that perfect as a computer. The problem is that if we would like to move credit risk assessment from past to future, which makes it much more reliable, much more strong, we need to use the property of human being, which is called imagination. So, I think it is 22 Miles movie. I found that quite short explanation where the chief explains to security officers or whatever, this special force, that he gives several examples of events which wasn't predicted by analysts. By the way, one of them is September 11, because they never happened in past. To predict them, you need to use imagination. You need to become actually that terrorist or that ship captain, or who did a mistake, and so on and so forth. And you need to use imagination. So to me, computers give us a great deal of tools, whole bunch of tools, able to track changes, able to do routine job, and to stimulate our decision making or our investigating processes. So yes, routine things supposed to be done by computers, but understanding of customers' business, working with human beings on the other side, establishing relations and everything, which is also called credit managers, supposed to be done by people.
Yes.
I was impressed. I was going through one of the most interesting courses in my life. It was delivered by Joe Pimbley. It is now, it lays for free on YouTube. It's about credit portfolio management. And what he said surprised me that time, and I still repeat it. He says, credit risk assessment and everything is not correlated with credit success. What really correlates with success in credit management is understanding of a creditor, how much a creditor understands customers' business. That's, by the way, why most successful credit departments and companies have a credit team working for tens of the years. 50, I mean, these people, like they know their portfolios. They know their portfolios up to the last detail, and they feel physically changes in this portfolio, because that's what we need.
No, I 100% agree with you there. I mean, we at the last company I worked at New Star, which was a commodity smelter miner, our credit team closely. I mean, they reported to me, but I would say they work closer with the sales team. They used to go out to meet the customers. They understood the business a lot more, and I think that was very, very, very helpful. Not many. I haven't seen that. We didn't do that at Swissport, but at New Star, that's very helpful. And I think this collaboration, this constant feedback loop between credit and sales, and even other departments, needs to happen on a regular basis in order to feed that. It's also real-time information that many people have, and somehow that decision doesn't go through. And I can give an example. When I was at when I was at Swissport, the very first day that I started was dealing with the bankruptcy of an airline. I won't mention it because people are sometimes sensitive about these national airlines.
No sensitive information, please. We
No. People are sensitive about those things, but
as politically correct as possible.
and after a whole debrief around what went wrong, why could we see that earlier? We could see they were delaying their payments. One of the sales guys said, "But I knew they have not been paying salaries to their staff for the last 3 months." And I thought, "Why didn't you tell me or tell us?" Or I don't know who to speak to, or it wasn't part of the, you don't know who to speak to. I go, "Come on." So it also involves a cultural change in a way within an organization to get the rest of the organization aware. If they have this information, and a lot of information is held by internal teams that we don't know, but we need to find a mechanism to feed that information straight to the decision makers. This collaborative approach is I think it's vital, because it's not, as you said, it's not just the model that makes a decision. Otherwise, you just get a robot to run credit management. It's not. It's the people who feed off a lot of information to make that the end point, to make that risk adjusted decision at the end of the day. Yeah.
Risk-aware decision, risk-adjusted decision, and
whatever you want to call it.
Whatever. It doesn't matter how you call it. Just a question how you take decisions. We had a kind of approach where we simply compare, and I believe, a good decision is based on on comparison of two parameters. It's a credit demand, which is following sales. So how much receivables we need to achieve these sales, these or that sales, and then credit worthiness, and then there are differences between them. So when we got, you were asking how much time credit analyst has to analyze the customer. When this analysis is ongoing, it doesn't matter how much time he has, because it's not a question of analyzing in seconds. It's just a question. The credit analysis is supposed not to be done in seconds. It's supposed to be done timely. You may do it, a week, but if it is ready just at the moment when you have to take a decision, it doesn't matter how long it took to make it. Obviously, part of that is to be automated. And my favorite saying about credit analysis is that credit analyst is not calculating, credit analyst is writing, because that's the real gold produced by credit analyst is his opinion about the company, not the number given by the model, whatever number it is. But when we turn everybody into the future, although we understand that it's impossible to predict it, but when we turn everybody's head into the future, we see credit demand, which is coming. So we see that demand for credit is growing and the credit worthiness is deteriorating, or it is growing as well, or it stays the same.
Mm-hmm.
We look and see this difference and we understand, or we try to understand what could we do about it. And when we do that regularly, as you perfectly said, when this process is ongoing, when it is routine, and we sit together, general management, finance, sales, everybody, we look at it and say, okay, we see that we need to, customer sales are growing, but at the same time, their financial strength is going down. So what we could do about that? And when we do that now, looking into future, we work in a predictive basis, and we still got comfortable situation to discuss and to find solution. Because when, for instance, receivables are pushing up credit limit and we don't have credit limit approved, and then we start blaming each other, shouting in each other, and got all of this nice discussion, including third party. There is no time to take good decision. So being preventive, working in a preventive way, helps a lot. As Eisenhower used to say that, that's his phrase, that planning is great, plan is useless.
Very true.
We nearly answered the question, who's supposed to say the final word? So we got model who is able to predict, and they do good job. But about the credit decision, to take risk or to grant credit or not to grant credit, who supposed to say final word? Is that because there is a big discussion. Some people say that people have limitations. Their decisions could be emotional, could be personal, so on and so forth. And artificial intelligence and computer and logic is free of all of that, so they take better decisions. But at the same time, I must say that whether or not what we call artificial is really intelligence, and it is complicated enough. So who do you think supposed to say final word in terms
on a credit decision process?
On a credit decision.
I really think I was going to say the person who pays your salary, but it sort of comes from that.
Yes, I got an answer to it, but yeah, the one who pays you salary.
Exactly.
If you have to take decision.
No, it really does come down to the credit policy that you've set. The board, the management who approve a policy. You've allocated certain amount based on a particular scoring methodology. And that's a decision-making process. Once again, going back to my line in the sand, if you cross that line, there is a collective decision to cross that line, and that allocation of responsibility and accountability lies with that person who pays your salary at the end of the day. But but just to go back to as a simplified way, I mean, it really is the model is probably the last piece that drives a number. And if your model is good enough, that feeds all the other analytical parts together and it spits out a number into a matrix or something like that, then that would be the last piece. But it's the analytical part around the modeling part, around the model.
That
makes sense.
Let me be a bit of Jesuitic and ask you, and who decides about the model? Who's supposed to? Who's supposed to decide? But to me, to my understanding of credit management, adoption of a certain credit policy is already a decision.
Correct.
Because the credit policy is actually document or whatever logical platform which is supposed to dictate about 80% or 90%, depending on the company, of decisions taken. So it says this is black, this is white, and this is yellow. We take only black and yellow, we don't take white, and so on and so forth. And then everybody's supposed to exercise their discipline. But credit policy is already a decision. And whether have you ever seen, by the way, any model which builds a credit policy?
No, you derive a model to build the credit. So as I was saying from the beginning, there's a risk tolerance that is acceptable by senior management, right? And that's why it's a top down approach. And the model, of course, the building blocks of a model, the data inputs, and so forth.
Yeah,
it's a collaborative methodology with sales and others to ensure that we come up with a number that makes sense, that we are still making money as a business, and at the same time we kind of manage the risk on a sensible basis. So at the end of the day, it's that collaborative risk model which draws a line in the sand and says, yes, this is the decision that we're going to make, and that should be it definitely should be in synchronized with the policy. If it's not, then there's something wrong. but that's the way that we kind of did it when we had it in sport and other companies. And so, like I said, if you want to encroach the line, go over the line, that's a different decision-making process. But that awareness needs to be there. So yes, that model dictates everything at the end of the day, because it's quantifiable, it's digital, and it should make sense. It should be transparent and accountable to everybody.
Yeah, that's clear. But I still say that this is us, or the one who takes final responsibility for all, decides which model to use. So final word is actually still said by a human being. And
yes.
when we need to do a deviation, at good credit policy we had a very nice air with credit chat with Ragay Nasser discussing credit policy. We found that credit policy itself as a document supposed to contain a part which explains when and how the deviations or exceptions could be given, and when this policy is to be reviewed or changed or readapted. And to my understanding, personally, it's better not to have credit policy at all than have wrong policy. Because it's quite easy to cut all the sales and get out of business just because. And then true, but we had credit policy, everything's correct. And yes, to my understanding, we still take responsibility, because there would be no artificial intelligence or model who's gonna pay us back our money if it makes a mistake. So responsibility is ours, because that's our head who is, and our pocket actually, who is responsible for our decision. And the decision to use or not to use kind of model, or whatever model it is, will still be ours at our own risk. But on the other hand, on the other side, ladies and gentlemen, if you believe that it is possible to create or write a good credit policy without understanding of your portfolio risk, I believe you overestimate your capacity. So knowing portfolio risk, knowing your plans and knowing your portfolio risk is actually paramount to build the right credit policy. And well, you would never believe, we had in Russian, I had once during the year, I had kind of rubric which is called bad advices about credit. It's quite famous book in Russian, The Bad Advices, and that was quite funny. I was reading that on the internet, what people advise how to assess credit risk, reputation of owners, payment behavior, assets, turnover, and so on, and so many things. How can we judge on customer creditworthiness having only turnover? But people advise that.
No, exactly.
So yeah, we need to use objective things. And saying back a final compliment to credit risk models, whatever critics are already given in the last hour, I must say that without scoring models, it would be a human, our brain won't be able to have a synthetic judgment about this or that counterpart. So sooner or later we need to, whatever way we analyze. I've seen a couple of tools which are given, explanation about liquidity, about debt to equity, whatever, all of this, including potential. Even potential raiders attack, including compliance risk, everything. So it is divided up to last detail. But then, how to synthesize that? Finally, we have to take a decision. We grant credit or not. If every single piece of information says grant credit, don't grant credit, and so on and so forth, you would never be able to take that decision. So scoring models are giving us that nice opportunity to do that quickly, but we still have to use our judgment. Peter, what would be your final word about models?
Credit risk models.
Yeah, credit risk models.
My
Sorry,
point.
because people might be still confused. I did a bit too big confusion on the internet today.
I really like the comment today. You made my day. Look, it really comes down to as I said, it's a framework that is really a top-down approach. It's a collaborative method. It needs to have an input from everybody, and it creates the transparency that each organization does. You can apply predictive AI, machine learning, whatever model you want to use, but it all comes down to the collaboration and getting as much information as early as possible, and having a disciplined sticking approach. Although you need to recalibrate now and then, depending on events and so forth. But that's my kind of methodology, or that's our philosophy that we try to adhere to when we created the whole platform in terms of getting and the way that we operated it at Swissport and other companies that I worked at. So it's not a black and white answer. As I said, it's a lot of different inputs. You're building a puzzle, but at the end of the day, you should be building a puzzle which is called the credit score to make a final decision, and a line in the sand, as per my beach. That's enough of analogies for today.
Yeah, I think so. Well, Peter, I think we are done with our agenda. So, ladies and gentlemen, the time and the floor is technically yours. Please feel free to ask your questions. Otherwise, I will be asking my tricky questions to Peter myself, because I got a lot to ask him. So please use the opportunity to ask questions, and we're happy to provide our answers. And I got, while people are thinking, I got a question to you, and I've seen many disputes about the compliance risk in risk management community. And I was quite interested to ask you. I actually made a quite long, evolution from understanding that compliance risk could be zero. or should be zero, because that's legislation, because that's everything. But there is still a big gray area in that, where you still have, because I was speaking with many compliance officers, and I believe you got a solution for compliance risk. So what is your understanding about the compliance risk? So where we can
apply that to the overall evaluation.
Because compliance risk is still, to me, it's still a tricky thing. Because, I mean, I will share a bit of my methodology. I divide credit risk by several scenarios. Yeah. And, bankruptcy is only one of them. There is fraud, there is long-term fraud, there is bankruptcy, there is country risk, and there is compliance risk. There is also industry risk. But compliance is still the most tricky thing out of that, where, again, you cannot work as black and white.
No, compliance is a different adaptation, I think, to the analysis of a particular company. It really depends on whether, I try to divide it into two sort of branches. One is regulated and one is non-regulated. I mean, the regulated is quite clear. It's a lot stricter in terms of, if you want to look at particularly UBOs or some other sort of AML sort of analysis around ownership structures, organizational structures, and things of that nature, then I think that's more clearer. On the unregulated side, say, for example, in industry and so forth, it's not applied that widely, I think, unless there's some trade going into sanctioned countries and things like that. That's more stricter. Then it's a black and white decision, right? So if it's on a sanctions list, we don't do anything with that. So we have that checks and so forth. But around UBOs and whether money is coming from a particularly some wherever, a funny family or whatever the case may be, I think people are more relaxed about it. Sometimes there is some knowledge about it. It's good to have a knowledge about it, or sometimes it's better not to ask. But typically very little analysis is done around that, unless it's pure sanctions where they could be fined. So if there's no penalty surrounding that, there's very little analysis done. So people tend to focus on sanctions list primarily in unregulated markets. The regulated,
where it is, let's say, black and white. You understand that if you put 2 fingers into the socket, you will be punished. That's clear. And other things, it is go by practice. Well, thank you, and it's great to know that you got solution for compliance risk. We will have enough to discuss about that later on. Well,
there doesn't seem to be any questions. I'd love to hear what your audience, what kind of credit risk models they apply, and sort of around that nature.
Please don't hesitate to ask questions.
Yes.
If you wish to enter into discussion, please mute off and join us. Maybe the topic is quite difficult to people, because you would be surprised. Yesterday, I think I was speaking with my colleagues in Ukraine, and they said it's quite difficult to find a person able to do portfolio analysis, and this is quite big company. And well, if I would be offered this job 10 years ago, I would be more than happy, because that's international company, so complex portfolio and quite big.
Yeah.
And now they say we are unable. I mean, one of the ideas is approach wrong, but no, not completely wrong, because they call a credit manager the one who is really a credit analyst. But make a job of doing a portfolio analysis is amazingly interesting job. Doing portfolio,
I mean, that's quite odd, because normally with the people I speak to, portfolio risk management, it doesn't really occur in many corporates. I think it's more around sourcing the data, putting it together and so forth in a coherent manner. That I think that's partly the thing, and also education process. I think people tend to focus customer by customer. They have a customer list, and that's the way they tend to focus. But I think we have a question.
Yes, we got Tiago. Thanks for session. In case the company relies excessively on models to apply credit limits, even to the point that it overrides human decision, how would we be able to convince management of the impending risks it may bring? Impending, I believe my English is too weak to understand what is impending risks. But, well, Peter, would you like to be first?
Yeah, I mean, this is exactly what I sort of mentioned as well. Going back to the line in the sand analogy, there is well, if there's imminent risk, you would not. I think.
Thank you for correcting me, because I recognize English is third language for me.
I mean, there's always a risk. I think if it's imminent, then clearly you would not want to enter that risk at any point right now, because the probability must be quite high. But if it's something that it goes over a certain calculated credit limit, as I mentioned before, I think it's quite helpful to then rediscuss or have a conversation with sales and credit, understanding what that risk is, and have that additional sign off, so that the accountability, the responsibility, it kind of raises. I mean, it depends on the value, the amount, if it's on that, but definitely that should be raised further up the chain, in order to get that. I still think, as part of the last question, which says the last word, as I mentioned, if it's the model that sort of dictates the last word, then anything over should be rediscussed and reanalyzed, whether it makes sense. Because if you're taking additional risk, you should get additional return, right? That's the general economic theory. So why are you taking that additional risk? You should have additional margin, additional strategic benefit, whatever the case is. I think that's my
completely
answer.
With you, Peter. Yeah, and Peter, and I just add to that. I will repeat Peter's question, Tiago. Why taking that risk? Because, as I said, a small number of companies look, I give you a general background of that. 90% of transactions in the world happen on credit terms, which means that one party grants credit to another one. So this means that about 10% of companies are able to deal on cash in advance basis. Good example is retail, but there are some other, even B2B companies, mainly those who enjoy hyper demand on their products. About 15% of others, let's say, about 15% of companies also enjoy that hyper demand and able to dictate the credit terms upon their customers. So they say the credit term will be 30% and not more. You're supposed to be that credit fourth, if not more. So, and nothing happens. They still sell because companies or other purchasers continue to buy. This is the question. If you might work for one of these companies, and on that level, if there is no impact of additional credit risk on their sales, or this risk avoidance, or their risk avoidance does not impact their sales, their growth, why to take that additional credit risk? That's one of the story. But another one, if a company who has to compete, who has to find solution, who has to take risk in order to compete, which is the destiny for the 75% of companies, and the company don't do that, the way to explain that is actually to show how much sales potential the company loses or don't utilize because of inability to deal or inability or unwillingness to take additional credit risk. And furthermore, taking credit risk is only one of the 5 possible decisions. I mean, classic of credit management says that the risk could be avoided, could be taken, could be transferred, could be hedged. Yeah, and could be mitigated. I don't believe in that. That's why I make this mistake always, because I don't believe in mitigation of credit risk, because customer either paid or not. So we or if there is somebody who will pay for customer if customer don't, or there is nobody. I mean, my strict experience is like this. I don't believe in mitigation in terms of credit risk, but hedging we can use when we create bad debts provision, and when we can transfer risk to a third party, we can insure it, we can use bank guarantees, we can do lots of things. But each time we grant credit to a customer, we need to ask ourselves, what do we get against? Yeah, what is against it? I supposed to do again this year. I was supposed to do a credit management course, and one of the simple exercise I give to people say, imagine we got a customer who works with us on cash in advance basis. That's quite simple, yeah. And then this customer comes to us and say, I would like to have 30 days credit. And then what questions we need to ask ourselves? First question would be, how much? We understand that granting a credit to this guy, we're supposed to, credit brings necessity to finance, which is cost of finance. We like it or not, and it brings credit risk of certain amount. So before we take these two expenses, we need to understand what benefits we receive. Would we have more sales, or the sales gonna be the same? Or will we maintain this customer, or customer go to our competitors, and so on and so forth? So this is a enlarged answer to that. Before we take risk, we need to ask ourselves, why do we do that? If there is no clear question, there is no clear answer to that, we need to find it before we grant credit or even think about it. Tiago, thank you very much for great question. I really enjoy it. Well, we still got silence. Peter, maybe you have question to me. Otherwise,
no, I
already offered me a beer, but I need 3 hours to come to you.
Exactly. We should catch up sometime. Have it live.
We will do for sure, because I will be visiting Zurich this year.
That would be fantastic. No.
Okay, ladies and gentlemen, we do thank you for your silent patience to the fun we had together with Peter. Thank you very much for joining us, and I do thank you, Peter, for joining me and giving that great pleasure. Maybe you got kind of final word.
I just want to say thank you as well for the opportunity to chat. Like I said, it's always a pleasure. You have a lot of insights which are quite beneficial. So thank you again.
Yeah, thank you very much all. Thank you very much for. I see if would like to. Yeah, please. Muhammad, please.
Hi, good afternoon, Peter, Henry. How are you doing?
Hey, Muhammad. Good.
Yeah, we are good.
All right. A quick one. Before granting any credit limit to a customer, especially for a new customer, what are the 5 key points we should consider, especially, as I said, for the new customer? Existing, okay, we know that what is their history, how they are paying, like their capacity. But especially when we grant a credit limit to the new customer, it's quite risky. We don't know that how they will pay. And so what do you think? What are the top 5 key points we should consider while granting any limit to them?
Okay, top 5, yeah. The top 5 points about the credit granting. So how do we derive the credit decision? So you were decision maker, Peter, and the credit decision maker, and I used to be credit decision maker myself. So what would be your top 5 points? I'd prefer not to hear than to give mine and then compare. But since you are you are allowed to, you have the right to be first in everything.
Yeah, thank you very much for that. Thank you for the opportunity.
In everything you want.
I'm not sure if I'm going to say top 5, but just the top points, which are the key points, would be to really understand the business, understand the business model, behind that company that you want to grant credit to. As Andy said before, do we actually need to grant credit? Is there a competing force which we need to adhere to, and then really look down into the financial statements to understand the financial, the balance sheet risk, the various ratios, whichever credit model you want to utilize, and then try to and speak with management and so forth to understand what that is. And what we did at previous companies that I worked at was we typically, if it's a new customer, we would work on providing not the full credit that we would normally give if it's a long-standing customer, because we wanted to understand them a little bit better, is to go halfway, to meet them halfway and provide them with some form of unsecured credit, and then the rest would be through some form of security, whether it's collateral or guarantees or LCs and things of that nature. So that's the way we try to work with the customer in order to gain their business.
Thank you, Peter. And I don't believe these are 5, because normally, if you ask me, I say you need to know 2 parameters, which I mentioned already today. You need to know credit demand, and you need to know credit worthiness. You need to compare them and decide what to do with difference. To elaborate a bit on that, we understand that there are sales. So every customer brings us potential sales. Then we need to understand what would be the credit term first. Then second, we need to understand whether or not we would be ready to grant this customer any credit at all if we are ready. And this could be, range of possible decisions, because we need to look at risk of fraud. We need to look at compliance risk. We need to look at country risk if it exists. Then we need to look at industry risk. Then we need to look at financial statements, which gives us a bit of idea of their risk of default and their credit worthiness. So we need to go that. But first question would be still, why do we need to grant credit to this customer? For instance, why don't we give them a discount and work on prepayment basis for the very beginning? Either they have this money or not. Then if we got this difference between credit demand, as I said, giving an example, we have $1 million credit demand, and then we have then we have a credit worthiness of $500,000. Then we need to decide what can we do about this having $500,000 conditional credit risk. We take it, or we simply say, okay, we give you just $500,000 but not more, or we use a bank guarantee, or we insure that, and so on and so forth. So credit decision, I'd never believe. I believe the right way, the right word would be not decision but a solution. So if we need these sales, we're supposed to find a way to work with this customer. That's what credit management is about. And also another, one of the most important points which I would like to highlight and underline is credit term. To me, only credit term is actually a topic to special masterclass which I did. It is on our channel. Credit term is to be investigated quite deeply because there are at least 8 factors affecting credit term. And normally companies use a couple of them. To me, that was, heartbreaking moment when I seen credit executive on the stage in the panel discussion. He was asked, how do you establish credit terms? And he said, we normally follow the request of a customer. You need to work 20 years and you got F designatory letter, whatever it is afterwards. I won't be mentioning that, but there are certain things which people of certain professions are simply not allowed to say, even if you have to do that.
Yes.
So there is Muhammad. There is no simple question or top 5. Credit decision, or what, as I said, credit solution is actually one of the most interesting topics about the credit management. Why so? Because I strongly believe that I would say at least 50% of our credit performance depends on the credit terms we establish to our customer, and the adequacy of these credit terms is hardly dependent on the level of sophistication we use when we establish credit terms, because credit terms could be or should to have customer payments on time, to receive payments on time. We must make sure that our terms are adequate to our business, to customer business, and to the market itself. And we need to adapt them every time. Credit worthiness, credit demand will be changing, and so on and so on. So therefore, I would say there is no simple answer to that. But the more sophisticated, the more advanced approach you use, the better your chances to establish good credit terms, adequate credit terms, and receive payments on time. I don't believe I gave a clear answer, but it is what it is. There is no, if the granting credit would be that simple, we would never see bad debts and overdue in the annual reports of companies.
Very true, Andy.
There would be never 2008, 2014 impact of COVID and everything.
We wouldn't have a job.
Yeah.
That's simple. So it's a lot of analysis involved. Yeah.
Yeah.
Agreed.
Well, it's 16:28. Peter, I do thank you very much.
Likewise, thank you
again for your today's participation, for today's fun we had, and I hope to see you in person and on any further events. Ladies and gentlemen, thank you, gentlemen, I will repeat, ladies and gentlemen, and everybody, thank you very much for joining us, for finding time to join us and to participate, to ask questions. And you are very welcome to our further events, which supposed to happen in 2 weeks in English, in 1 week in Russian. And I do wish to everybody as high as possible sales, as low as possible losses, which in French-speaking environment could be called bon crédit. See you. Bye-bye.
Thank you.
Thank
Bye.
you.